In this video, we are going to look at tax incidence for inelastic supply and elastic supply. So firstly, let's look at inelastic supply. Inelastic supply means when there is a price drop, there would be a smaller percentage change in the quantity demanded or smaller drop in the quantity demanded. So inelastic supply looks like somewhat like this. So the demand curve, let's draw demand curve. So when there is a tax being imposed, so you will have a parallel line shifted to the left because of the price increase. So this is price and quantity. This would be PT after tax, and the producer would be actually receiving P dash, and this was the initial quantity, and now the quantity would be QT. So as you can see here, for an inelastic supply, the tax burden for the consumer is much lower than the tax burden for the producer. So the conclusion would be, for inelastic supply, the consumer's tax incidence would be lower than producer's tax incidence. So now let's look at elastic supply. If you draw the line for elastic supply, this would be the demand curve, and this is supply curve, and because of the tax imposed, there will be a parallel line ST. This was the initial equilibrium P for Q. Now the equilibrium is here, PT, but the producer would be receiving P dash. As you can see here, the consumers are taking the burden of tax and the producers are taking much smaller burden here. So here, in conclusion, what we can talk about is, for elastic supply, the consumers' tax incidence would be higher than producers' tax incidence.